Hey, everybody, we are going to talk about inflation, everybody's favorite topic, because inflation has come down quite a bit. So it actually is becoming a favorite topic of the market. That's why the market's reacted so positively lately. It's because it thinks inflation is getting under control and we're going to see interest rates fall, et cetera, et cetera. Take a look at the message you see on your screen from our sponsor, The Motley Fool. You can get the top 10 stocks to buy right now. It's a great way to support this work we're doing on YouTube. So, just to kind of run through some of the recent data, and then I'll kick it over to Tyler, who's joining me for kind of what this means, what investors should keep in mind, and how what stocks could benefit from it, maybe. So we've seen two big inflation reports recently. We got the recent consumer price index, or CPI data, which is kind of the measure of what you and I are paying for goods and services. That was up by 0.03 in the month of December. That's month over month, and 3.4% year over year. That was 1.1% hotter than we expected. On the other hand, we got the producer price index, which are wholesale prices. That we got that the next day, and that was cooler than expected. So the producer price index actually dropped 0.1% month over month. So we're actually seeing some deflation. And core PPI, it was actually up by 0.2%, but was only up 2.5% for the year. So significantly cooler than the CPI. I'm not a big fan of the core PPI in this case because how can you talk about inflation without including food and energy? People are paying for that. So it's really a better measure of how much it's costing people, the overall number. But when you exclude those costs, which they're excluded because they tend to be rather volatile, it gives you a little bit of a better picture. So the expectations right now, after these two inflation reports, are that we're going to see the Fed cut rates in March. Right now, the market's pricing in a 70% chance of that happening. I'm pretty optimistic, and I'm not so sure that's going to happen. And 5 rate cuts in 2024 altogether. Tyler and I have talked about this before. I think the only way we get 5 or more interest rate cuts is if the economy's not doing so great, which wouldn't be a very good way to cut interest rates. So I also want to keep in mind that there is some delay between what the Fed does and when it's reflected in the numbers. Just for example, the Fed started cutting interest rates in 2022, a good 4 or 5 months before we saw inflation actually peak and start to fall. A lot of it takes a little while to be worked into the economy. So with that in mind, I've rambled off a few statistics so far. Tyler, what do you make of these two inflation reports, and what do you think we're in for going forward?
The thing that I think kind of stood out to me, and like you said, with the CPI print being a little bit higher than expected, is that one thing, and this is just kind of an investing lesson in general, is that things are rarely linear. There is a pretty good chance that we may have a report or two in the next year or so that is actually higher, showing higher inflation than what was indicated, and then we may see another one that surprises much further to the downside. These things never happen on the pace that you want them to do. I think there was a famous. I know Morgan Housel said it, but I can't remember if he was quoting somebody else. But it was basically, the market will stay irrational longer than you can stay solvent. And so there's just this idea of, like, if you're really banking on things like declining interest rates to like make your investment, just keep that in mind. Like, it's going to probably take a lot longer for that investment thesis to play out, because it's not going to be a linear trajectory all the way down. I foresee, there could be a lot of things coming down the pipe that could have, surprises for higher inflation. There are some components that are very volatile, like you mentioned, food. But, one thing that you and I have talked about a lot is, like, there's a bit of a housing crisis and a housing affordability crisis in the United States. And a big portion of that is undersupply of the market in terms of housing. And as long as the housing market remains undersupplied, it's going to be very, very hard to bring to reel in shelter cost and shelter cost inflation. And that's a huge component of, excuse me, of the consumer price index. And so while there are aspects that could come in cooler than expected, it doesn't all work in harmony. And so one thing that I have been thinking a lot about lately is, with housing being such a big component, it's going to be hard to reel in inflation really down below those levels as long as housing remains high. And I've mentioned this before. I'm kind of the opinion that the Fed won't cut unless they feel they have to. And so it's a little bit of, what's the rush? We can always do it tomorrow when we absolutely need to do it. I think the Fed is probably going to lean more towards the idea of not cutting and then, cutting too early and risk having inflation kind of, charge back up. I think that's kind of the greater risk for them, and therefore, in my opinion, I think like we're much less likely to see rate cuts happen quickly, and as you said, as frequent as like 5 and 24. That seems way too ambitious for anyone who thinks like the economy is going to do anything less than have a severe contraction.
Yeah, I think we are kind of in agreement when it comes to the direction of interest rates, right? We both believe that they're going to generally gravitate downward from here. We disagree on, how long it's going to take. So I would say, just real quick, what are some of the sectors and industries that you think have the most to gain from interest rates going down? And I'll start. I think financials are going to be a surprising winner. Generally, it's the common thought that financials are going to do well in an environment where interest rates are rising because it means more interest income, but it also increases their cost of capital. And when you have we've had elevated interest rates for a year and a half, 2 years now. People are still taking out loans. You have a lot of banks with a lot of high yielding loans on their balance sheet. And as their cost of capital comes down, meaning the rates that they're paying on savings deposits and things like that, you're going to see that spread really widen. And that's especially true if we end up getting a soft landing in the economy. Tyler, any sectors that you're looking at that you think could benefit tremendously, other than small caps, which I know we've already discussed?
Yeah, I mean, a lot of the interest rate sensitive businesses, slow ones, high dividend payers that where, the bulk of your returns come from dividends. So utilities, probably even to a lesser degree, REITs as well. A lot of institutional investors will probably that have shied away from those industries recently because it's like, well, why would I buy an equity and take on all that extra risk from an equity when I can get the same return from debt? And so when you have options like that, yields on utilities and REITs are much less attractive. But if you get a lower interest rate environment, then those become attractive again, especially after a lot of utilities having and REITs to a certain degree just having a tough 2023 in terms of returns, simply because a lot of flight away from them to chase high yield in fixed income. So if that were indeed the case, we were to see some declines in interest rates, I think it would benefit those sectors a lot, just simply because like that's where institutional money is going to kind of change hands.
I would agree with that. I think, the one that we always talk about is real estate, which is kind of, I don't want to say an obvious beneficiary of lower rates because it's not necessarily a big beneficiary if we have lower rates because of a bad recession. Um, but in general, REITs are you know, they're a rate sensitive sector. They're generally yield based investments, um, which tend to do poorly when rates rise and better when rates go down. They depend on borrowed money more than almost any other sector in the market. It's kind of like how you and I buy a house with a mortgage. Same idea with REITs. So I think REITs could have a very good year after a pretty terrible year, a pretty terrible couple of years they've had recently. I think this could be a big year of rebound for REITs. So, what are some sectors that wouldn't really benefit from interest rates? Do you have any good ones there?
That's a really good question. I haven't thought about that one that much. I'm gonna
I know
punt.
I'm putting you on the spot here.
I'm gonna punt. I haven't thought about that one enough. But sounds like a great topic for next week.
I, well, I would say that just my thought is the Magnificent Seven are not going to do well in a falling rate environment, just because a lot of investor capital is going to be flowing into these other assets we were talking about. You're going to see a lot of people kind of right now. People have bid those up. There's the AI hype. There's a bunch of reasons why the largest companies in the market have gotten a lot of investment. I think that's going to flow outward as rates fall. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.